32 nations just dumped 400 million barrels of emergency oil onto the global market, the single largest coordinated reserve release in recorded history. And it barely moved the needle, because the real crisis was never about oil. February 28, 2026, military strikes by the United States and Israel against Iranian targets triggered immediate retaliation, and the Strait of Hormuz, a choke point just 21 miles wide at its narrowest, went dark. Commercial vessel traffic collapsed by 97%, plunging from 141 daily transits down to 4. Roughly 14 million barrels per day of net oil export capacity vanished from global markets overnight. Iran's counter-operation targeted the energy supply chain directly. The Islamic Revolutionary Guard Corps hit Saudi Arabia's Aramco facility at Ras Tanura, struck Qatar's Ras Laffan LNG complex, and attacked UAE-registered oil tankers. The goal behind it was deliberate: to inflict so much global economic pain that military operations would stop. Within days, Brent crude surged from around $70 per barrel to a peak near $120. Storage tanks across Saudi Arabia, the UAE, Kuwait, and Iraq filled to physical capacity almost immediately, which meant producers had no choice but to shut in millions of barrels of daily production. Citigroup analysts ran the numbers and estimated that between 11 and 16 million barrels of daily supply had been entirely erased from the global market. On March 10th, the International Energy Agency convened an emergency meeting of its 32-member governments. The following day, Executive Director Fatih Birol announced unanimous authorization to release 400 million barrels from emergency reserves, more than double the prior record of 182.7 million barrels deployed after the 2022 Russian invasion of Ukraine. What made this response extraordinary, and what makes the outcome so alarming, traces back to where strategic petroleum reserves came from in the first place. The 1973 Arab oil embargo quadrupled international oil prices almost overnight, exposing a dangerous truth about industrialized economies. Their entire foundation depended on imported hydrocarbons they could not control. That crisis created the International Energy Agency in 1974 and prompted the United States to pass the Energy Policy and Conservation Act of 1975, formally establishing the Strategic Petroleum Reserve. Engineers selected the Gulf Coast for its abundant subterranean salt domes, which offered geologically stable, highly secure storage near major refining hubs, and the first delivery of 412,000 barrels of Saudi Arabian light crude arrived in July of 1977. The system barely had time to take shape before the 1979 Iranian Revolution delivered the second major shock. Shah Pahlavi's regime collapsed, and Iranian output dropped by 4.8 million barrels per day, roughly 7% of world production. Panic hoarding and speculative behavior doubled the economic damage beyond what the actual physical shortage justified, driving oil from $13 to nearly $39 per barrel and pushing U.S. consumer inflation above 13%. January 16, 1991, brought the first real test. President George H.W. Bush authorized the inaugural emergency SPR drawdown alongside Operation Desert Storm, and the Department of Energy offered 33.75 million barrels, ultimately selling 17.3 million to 13 companies. The gap between what the DOE offered and what actually sold exposed a technical reality that persists today. Refineries need specific crude grades. Bids for high-sulfur sour crude came in far below bids for low-sulfur sweet crude, and the DOE held firm, accepting only offers above 97.5% of benchmark prices and explicitly rejecting bargain hunters. Oil prices dropped by about $2 per barrel, which validated the core idea that a credible promise of sovereign supply could calm market panic. Hurricane Katrina hit in 2005 and shut down 25% of U.S. production overnight, sending wholesale Gulf gasoline from $75 to $135 per barrel. A coordinated IEA release of 60 million barrels followed, with the U.S. contributing 20.8 million through a combined approach. 11 million barrels in operational sales, plus 9.8 million in emergency exchange loans that kept refineries running through the worst of it. That episode proved reserves could address localized infrastructure damage, not just geopolitical confrontations. Libya's 2011 civil war removed 1.6 million barrels of daily production, mostly high-quality light sweet crude bound for European refineries. Another 60 million barrel release followed from the IEA, with the U.S. contributing 30.6 million barrels, but the result was telling. The initial 6% price drop evaporated within weeks. By early July, oil prices had climbed back to exactly where they started. Europe's response came apart at the seams. France, Italy, and the UK met their obligations by lowering stockholding requirements on private industry, rather than releasing actual public stocks. Germany tried to move 4.2 million barrels, but managed to sell only 63%, because half of its inventory consisted of refined products and Middle East heavy crude that European refineries could not process. Without precise crude grade matching and unified execution, the stabilization effect evaporated. And that brings us to the 2022 watershed. Following Russia's invasion of Ukraine, the IEA coordinated a then-record release of 182.7 million barrels. The U.S. alone deployed 180 million barrels over 6 months, and a Treasury Department analysis calculated this lowered retail gasoline by 17 to 42 cents per gallon. The price tag, however, was steep. The SPR drained to a 40-year low of approximately 415 million barrels. What followed was an unusual fiscal maneuver. The U.S. had sold its 180 million barrels at an average peak market price of $95 per barrel, generating $16.95 billion. And when prices stabilized, the DOE bought back 59 million barrels at $76, netting the federal treasury roughly $3.5 billion in profit. None of that mattered by 2026, because Congress had treated the reserve like a piggy bank in the years between. Between 2018 and 2025, lawmakers repeatedly authorized sales from the SPR as budget offsets for completely unrelated legislation, raising approximately $18.3 billion. Replacing the depleted inventory will cost an estimated $20 billion, leaving taxpayers facing a net fiscal loss on their own emergency reserves. By the time the 2026 Hormuz crisis erupted, the reserve was already badly weakened. The U.S. committed 172 million barrels to the coordinated release, with Secretary of Energy Chris Wright explaining that full discharge would take approximately 120 days. Japan committed 80 million barrels, given that the strait supplies 70% of its oil imports. Germany and Austria confirmed participation immediately. And this is where the math falls apart. The U.S. Strategic Petroleum Reserve sits in 62 underground salt caverns, spread across 4 Gulf Coast sites in Texas and Louisiana, with a theoretical maximum drawdown of 4.4 million barrels per day. The realistic sustained output, held back by aging infrastructure and decades of deferred maintenance, ranges between only 1.4 and 2.1 million barrels per day. American consumption alone runs at 20 to 20.6 million barrels daily, which means the SPR's maximum contribution covers roughly 10% of what the country burns through in a single day. When the global market loses 11 to 16 million barrels per day from the Hormuz blockade, the combined output of every allied reserve on the planet simply cannot fill the gap. On top of that, released SPR crude takes 13 to 21 days to navigate distribution pipelines, load onto tankers, and reach the open market. During that window, the market runs on the psychological promise of future barrels, not actual oil arriving at refineries. Financial markets spotted this weakness instantly. When the IEA's intentions leaked on the evening of March 10th, Brent crude futures dropped sharply below $87 per barrel. Algorithmic trading systems adjusted within seconds, and hedge funds unwound long positions within minutes. The next afternoon told a different story. Despite official confirmation of the largest emergency release in history, oil prices resumed climbing, pushed past $90, and spiked toward $101 overnight. Institutional traders understood that 400 million barrels represented less than 3 weeks of supply replacement if the strait stayed closed. Game theory predicted exactly this outcome. Creates a classic public goods problem, where the benefits of lower prices reach every consuming nation, regardless of whether it contributed a single barrel to the effort. Oil is globally fungible, meaning an injection in the United States lowers the benchmark for a buyer in Jakarta or Mumbai, which creates a powerful incentive for individual nations to hoard their own reserves while enjoying the price relief that cooperating states subsidize. India, the world's third-largest oil consumer, chose to review its position and initially abstained from the coordinated release. Models estimate that the absence of a demand center that large reduces the market-stabilizing impact by 15 to 20%. China added an even more unpredictable variable. As the world's largest crude oil importer, China holds vast reserve capacities that remain deliberately opaque. During previous market cycles, particularly late 2021 and 2022, unilateral Chinese reserve releases operated completely outside the IEA's coordination framework. When the IEA tries to engineer a specific market outcome through synchronized injections, simultaneous but uncoordinated actions by non-member states distort pricing models, misalign refinery utilization rates, and confuse algorithmic commodity traders. Japan bypassed the formal coordination process entirely, unilaterally announcing an immediate drawdown. In game-theoretic terms, this counts as temporal defection, intended to reassure domestic consumers, but fragmenting the psychological impact of multilateral action and signaling panic rather than solidarity. Research from the Federal Reserve Bank of Dallas confirms these limits with hard data. Their structural model found that unannounced, asynchronous releases produce almost no measurable sustained drop in crude prices, while unannounced government purchases to refill the SPR reliably push prices up by about 1%, a distinct and troubling asymmetry. A study tracking 40 SPR release events across 36 major oil firms showed equities declined by a marginal average of just 0.32% in the 5 days surrounding a release, and exchange-only releases actually produced a positive equity response of 0.71%. Sophisticated market participants accurately price in the temporary nature of reserve drawdowns, reading them as a temporal supply shift rather than any structural expansion of production. The worst consequence of this energy shock, however, had nothing to do with oil prices. It hit food. 1/3 of global seaborne fertilizer trade, roughly 16 million tons per year, moves through the Strait of Hormuz. The surrounding region produces about 20% of the world's phosphate fertilizers and 25% of global sulfur, which is chemically required to process raw phosphate rock into plant nutrients. Once the strait closed, the immediate halt of Qatari natural gas exports starved the global nitrogen fertilizer industry. Natural gas serves a dual purpose in fertilizer production. It provides the energy for extreme processing temperatures, and also serves as the chemical feedstock for synthesizing ammonia, the basic building block of nitrogen fertilizers. Major fertilizer operations across India, Bangladesh, and Pakistan shut down immediately. Egypt lost gas imports from Israel and found itself competing in the hyperinflated LNG spot market. European natural gas benchmarks, specifically Dutch TTF, surged 74%. Global fertilizer prices experienced a 6.5% instantaneous spike by March 10th. Gulf diammonium phosphate climbed from $583 per ton in January to nearly $800 per ton, a 36% jump. Tampa ammonia settlements hovered near restrictive highs of $487 per metric ton, and urea prices spiked 30% within weeks. What no government had planned for was this: industrialized nations maintain massive, coordinated stockpiles of crude oil, but no equivalent sovereign reserves exist for fertilizer or agricultural chemicals. Releasing 400 million barrels might theoretically lower diesel costs for tractors and transport, but those barrels were completely powerless against the physical absence of ammonia and sulfur needed to grow crops. Timing made everything worse. Late February and early March falls directly before the Northern Hemisphere spring planting season. Farmers counting on March deliveries for April and May fertilizer application faced a crisis with no workaround. Even when sovereign navies eventually began escorting vessels through the Gulf, ship captains and military escorts prioritized high-value hydrocarbons over bulk fertilizers due to higher profit margins and strategic necessity, leaving agricultural chemicals stranded in port. The way this shock reaches food prices follows a well-documented chain. Indonesia offers the clearest example, where transportation accounts for 26% of total energy use across the entire food supply chain, the single largest energy input. Simulations of a 30% domestic fuel price increase wipe out 364 million units of total national output, with ground transport alone contracting by 46.6 million units. Among surveyed Indonesian farmers, 98.8% reported severe impacts on profit margins during rising oil prices. 90.6% reported financial strain that limited their ability to transport crops. And every single respondent, 100%, confirmed that oil price swings ultimately force wholesale food prices upward. What makes this damage so lasting is asymmetry. When fuel prices spike, transportation operators, processors, and retailers immediately pass costs through to consumers. When oil prices fall, those same suppliers exhibit extreme downward price rigidity, holding on to the expanded margin to recoup past losses rather than passing savings back to buyers. Once food prices climb, they rarely come back down. Indonesia's 2026 state budget assumed crude at $70 per barrel. At $150, the subsidy regime becomes mathematically unsustainable, swelling the budget deficit to roughly 3.6% of GDP and breaching the legal 3% ceiling. Abandoning subsidies entirely becomes the only option at that point, which triggers cascading cost-push inflation through the domestic economy. Indonesia's CPI weighs heavily toward food, beverages, and tobacco, with the largest contributors being broiler chicken, chili, fish, rice, and eggs, all perishable commodities that require energy-intensive distribution. Across developing nations, the damage multiplied. UNCTAD projected global growth to slow to 2.2 to 2.7%. Sovereign bond spreads widened immediately, with Iraq's borrowing costs spiking by 0.64 percentage points and Bahrain's by 0.41 points, effectively locking vulnerable nations out of international debt markets at the exact moment they needed deficit financing most. Currency depreciation deepened the pain further, because a food-importing nation suffers a dual penalty. Dollar-denominated prices for oil, wheat, and fertilizer rise from the supply shock, while the local currency cost of acquiring those dollars climbs simultaneously from exchange rate depreciation. Sudan depends on the Persian Gulf for 54% of its seaborne fertilizer. Sri Lanka, still recovering from sovereign default, relies on 36%. Tanzania draws 32%. Somalia, 31%. Pakistan faces falling foreign exchange reserves with bond yields exceeding 10% over U.S. Treasuries. Nobel laureate Joseph Stiglitz concluded that even a swift military resolution would still produce structural food inflation, severe yield drops, and widespread stagflationary pressures persisting through 2026 and 2027. History bears this out. During the 1973 oil crisis, the quadrupling of oil prices triggered a 180% surge in global fertilizer prices. And in 2022, the Russia-Ukraine war drove fertilizer costs up nearly 70%, sparking food security crises across the developing world. What 2026 laid bare is that strategic petroleum reserves function as bridges, not solutions. They buy time and manage market psychology, but they cannot repair structural deficits or bypass physical blockades. 400 million barrels, the absolute largest coordinated intervention in human history, represented fewer than 3 weeks of lost Hormuz transit volume. The hard constraints of the USSPR's daily extraction limits, combined with weeks of maritime delivery lag, proved mathematically incapable of replacing the crude physically trapped in the Persian Gulf. The deeper failure runs well beyond hydrocarbons. Downstream contagion into the global fertilizer market, driven by trapped Qatari natural gas and Saudi sulfur, set off an agricultural crisis that oil reserves were never designed to address. The pattern mirrors the stagflationary devastation of the 1970s and exposes one glaring gap: the complete absence of sovereign reserves for the agricultural chemicals that modern civilization depends on to feed 8 billion people. Once the largest strategic reserves in human history exhaust their stabilizing utility, the global economy stands exposed to compounding, self-reinforcing waves of energy inflation, agricultural contraction, and sovereign debt distress that fall hardest on nations least equipped to absorb them.